Good morning, traders. Richard Jeremy, quick Ichimoku cloud chart market review of Tesla. And what a correction we've had in the stock after a huge 163% run up. We had a 54% drop. The critical thing to remember here, as with all Ichimoku clouds, whenever stock gets too far extended from the top end of the cloud, it's a good idea to take profits right about there and then wait for the pullback and consolidation. Now, in this case, what turned out to be a nice orderly 50% or 38% Fibonacci pullback turned into a massive correction all the way right down to the next cloud chart support zone. So how much further down can it go? Well, 222 is the downside target here, 218, and the bottom end of the cloud 204 is the downside targets, together with 184 and then this low right here. Now that's the scenario on the weekly. So if we don't get support to come back into the stock, we're looking at these downside targets. Should see support being tested here at the top end of the cloud. It's a very thin cloud, not much support there, unlike this cloud that had quite significant support. And then we're now looking for a potential swing trade back up here, but only if we start seeing some positive candles and support to come in here. If support fails here, then we've got these downside targets to deal with in this overall correction. Look how it sliced through the standard line of the cloud there. It also sliced through the front end cloud chart support zone of 313 on the weekly Ichimoku cloud. But overall, you can see when a stock tends to go vertical like that in a very short space of time, there's always risk for a consolidation or correction, and we had that in this case for various other reasons that compounded the correction. Now let's go and take a look at the daily Ichimoku cloud. You can see here, sliced through the bottom of the cloud. That was another sell signal. There was another sell signal up there. There was another sell signal here. The taps opened all the way to the downside. It did not find support at this cloud chart shadow, this old support zone there, the top end of the cloud there. And then the next one was this one at 287 there, sliced through that zone as well. 287 did briefly try to rebound from there, and then the taps kept opening up, and now we're back down here at the bottom end of the daily Ichimoku cloud. There we go. 2238 222 was the downside target in this instance, but there's still downside risk to 204, 218 and 184 on this Ichimoku cloud. Looking at Tesla, let me just make this chart a little bit smaller. There we go. But you can see huge run up. Then the correction came, sliced through the top end of the cloud, sliced through the bottom end of the cloud, and then the taps just opened to the downside. Now it's back down to a major support zone between this top end of the cloud here and the bottom end of the cloud, but there's still some downside risk to 222, 204, 184, 185, and then this bottom end cloud chart zone there at the bottom end of the Ichimoku cloud there, 168. So these are all the downside risk targets on the daily Ichimoku cloud for Tesla if we don't get a support rebound from this cluster of support between 223, 218 and 222, as well as 204. So keep an eye on for support to come back in here. If support fails, then the rally to the downside will continue on the daily Ichimoku cloud. In the last update on Tesla, we did highlight the deterioration in the fundamentals. We look at the star mine models, the valuation momentum score, intrinsic valuation scale, all with trading in the bottom 10% of the market and still trades there. So despite this huge correction, Tesla is still quite an expensive stock. The price earning multiple of 89 with a forward one of 75 is quite high compared to the industry's average PE there. Also on a price to cash flow ratio and price to book ratio, all in the bottom 10% of the market. So it's a very unattractive stock from a valuation perspective. So any people going long this particular instrument, you should be clearly convinced of the upside potential, but purely on looking at the numbers, there's still a very bleak picture to the downside. Credit risk, there's a bit of a risk factor there that ranks in the bottom 25% of the market. Intrinsic valuation ranks in the bottom 2% of the market there, and the valuation momentum score ranks in the bottom 10% of the market. Earnings quality ranks 34, still suffer from very poor earnings quality, where we delve deep into the income statement, balance sheet, and cash flow statements to look at the sustainability of earnings, so it does not have a very good ranking. You generally want a stock with a percentile ranking of more than 80 for it to be considered a quality business. So it's still a very, from a fundamental basis, a very poor quality business looking at the numbers. Valuation momentum, still some downside on that basis, but the price momentum score is starting to improve, so we could see a technical retracement rebound on that basis alone, which is just ignoring all the fundamentals on that basis. So keep an eye on that. Now, do remember as well, in terms of the growth rates, the return on equity is around about 10%. It's very low. It's not particularly good return on equity, so you can deploy capital better at other places. Now, also note that last time we looked at the market implied growth rates, where we do a DCF and reverse engineer the growth rate, what the current stock price was implying, and the previous one implied a more than 30% growth rate in the stock, whereas the StarMine Smart Growth Rate is where we look at the most accurate analysts that are consistently accurate in predicting the growth rates in earnings momentum and earnings reported earnings for a company. That's about 10% growth. So the market implied growth rate, the stock is still very expensive on that basis, because the current stock price, if you reverse engineer near it, you use a DCF model and all the growth rates, comes out at 26%. The current price imply a 26% growth rate per annum in the future, and that's still very high considering the market prospects of the motor industry, so to speak. So watch out for that. Still very expensive on that basis. It will need a lot higher earnings growth to justify the current valuation in excess of 26%. Last time it was 30%. So even though the stock corrected 54%, it still remains very expensive on a DCF model basis. But keep an eye on the earnings quality there going forward. But valuation momentum still very negative, but price momentum starting to improve, so we could see a rebound there. Analyst revisions momentum is 34. That's analysts are generally very bearish on the stock as well. That ranking is very bad from a StarMine ranking model perspective. Just a quick review for what to look out for on the 4-hour chart. We can see in the last update we were around about there, looking for a quick choppy swing trade to the upside and then another short sell to the bottom. Then hit our 237 downside targets, 223 bottom end of the cloud chart target there. The next downside risk targets are 213, 204, 178 on the 4-hour chart. So keep an eye on for that level. If we don't get a support rebound from this cluster of old cloud chart support zone between 223, 213 and 204, we can still see further downside to 178. Now what we really want to do here, we want to swing trade this from a support rebound back up to the turning line there, the little green line there at 252. By that time the front end of the cloud will be another resistance zone to deal with, 275 there, and then the standard line of the Ichimoku cloud 291 will be the next upside resistance targets if we get a successful support rebound from this 222 downside target on the 4-hour. To be truly bullish on Tesla, we need to be back above the top end of the cloud. So you can see we are swing trading a relief rally in an overall downtrend of a particular stock, and you can both go long and then short again when it gets to these resistance zones. Turning to the 60-minute Ichimoku cloud, you can see there a bit extended from the bottom in the cloud. So if we get that relief rally at this 222 for support, watch out for the 242 upside target, 249, and then the 270, 261, that bottom in the cloud chart resistance zone, and then also this 275 upside resistance target. For Tesla to be bullish on the 60-minute one, price needs to be back above the top end in the cloud. So from a medium-term trading perspective, if Tesla manages to break past this, then that's another area for a second or third long position to grind higher. That's a bit more of a lower risk position than any trades below the cloud. Any trades, yeah, we are clearly trading counter trend if we swing trade to the upside, but the short selling when it reached cloud chart resistance, every time it reached cloud chart resistance, the short selling has worked very nicely on that basis. basis. If we just go back to the 4-hour once again, yeah, we need to be back above the top in the cloud. Also interesting to note, we've got these big waves here. One big move down, pullback, one big move down, pullback, and then a really another one. It's almost like a fourth wave if you think about that, and they're somewhat symmetrical almost, you know. There's a downward continuation pattern, so it's almost like they in sync. There's almost the same movement from there to there, rally, pullback, rally, pull back, and then a rally, and then a pullback. So it's almost like you look at the downward continuation pattern, sell off, pullback, sell off, pullback, and they're almost of the same length. If you look at these, yeah, from 419, that one to there is almost the same distance as that one to there, almost the same distance of that one to there. So keep an eye on that. We almost got a completion of a multiple downward continuation pattern in Tesla on the 4-hour. But keep an eye on for support to come back here. That will offer us swing trade opportunities and other additional short selling opportunities when it gets to the resistance zone. If support fails here, we're going down to 204 and 178 there. Let's just go and check the daily one there, just once again to make sure you've got an idea where the downside targets is. This bottom end of the old cloud chart shadow is also another downside risk target. Until next time, happy cloud chart trading. Bye for now.